Hey, good evening, all. Good evening. Happy Monday to everybody. Happy Monday to everybody. Hopefully, everyone had a wonderful and blessed and amazing weekend as I did. Um, this weekend was a weekend full of. Uh, I, 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 I don't think I've been to so much parties in one particular weekend in my entire life. It was actually very draining. This weekend actually taught me my age, to be honest with you. And about four parties this weekend, one graduation, and three birthday parties, which is crazy. But it was fun. It was enjoyable, right? But today I want to have a conversation with you guys, a serious conversation with you guys in reference to just the things that we were taught to believe, right? Today's conversation is the financial lies we were all taught, and why most people are unprepared for the future, right? The financial lies we were all taught, and why most people are unprepared for the future. Tonight, I'm going to talk about something almost everyone believes. Tonight, I'm going to talk about something almost everyone believes, but that most people just never questions. The financial advice we all grew up hearing. I think we all know what it is, right? Go to school, get a job, buy a house, save for retirement, buy term life insurance. And somehow we think that's going to protect our future. These are some of the advice that we've been given. And we never questioned it. We just rolled with it, right? But here's the truth. Those rules were built for a different time, a different world, not the one we live in today. And I believe some of you guys who are on this call, on this live today, have probably experienced that or are starting to see that those rules are not panning out. Question for you. If you've ever felt like normal financial advice just isn't enough anymore, I want you to type facts in the chat. If you ever felt like normal financial advice just isn't enough anymore, I want you to type facts in the chat. Right? Here's the problem. Most people are unprepared. Most people are unprepared for life. Half of Americans have some life insurance, but that leaves millions unprotected. only about 60% of Americans have some form of life insurance today. And 33% of Americans that have those life insurance say they are underinsured, even though they have coverage. That's half covered, but only 1/3 protected. If you think insurance, if you think the insurance you have might not be enough, I want you to type in the chat ready. It's a reason for that. It's a reason for that. Today, the breakdown for today is going to go over a bunch of things that we either don't think about or we either know, but we haven't started the process to get in order. Right? So that was life insurance. So we know roughly about 50-some% of the country, 52% actually, have life insurance. Another 48% do not have life insurance. And out of the 52%, 30% of them say they know they don't have enough coverage. The next thing is long-term care. Something almost no one ever plans for. Long-term care is probably one of the issues that a lot of people are going to go through in their late 60s, sometimes even earlier. And we're going to dive into this, right? But 70% of people between the age of 67 and 75 are going to need some form of long-term care. But when people plan for retirement, they never plan for this. Nearly 70% of adults turning 65 today will require some form of long-term care in their lifetime. 70%. 70%. But yet only about 10% of the people actually carry any type of long-term care coverage. That's shocking. That's shocking. Now, some of you guys might be watching this and you're saying, what is long-term care? Long-term care is things like or illness or injury, right? That hinders you, that stop you from being able to care for yourself. When we talk about critical illness, for example, critical illness, by definition, if you are unable to perform 2 out of 6 of the daily living activity, bathing yourself, clothing yourself, toileting, feeding yourself, continence, things like that, you will need some form of long-term care. You will need assistance, somebody to help you with this. And people do not plan for this at all. At all. Listen, before I go any further, right? If this is your first time running across my platform, you're going to learn a lot today. You're probably going to learn more things than most people in America know today. I want you to subscribe or follow And I want you to hit the like button because it helps push the message out. The algorithm help push the message out to people that need to hear this. And then if what you're hearing today, if you're getting any value out of it, and you feel as though that there's somebody out there who you know that might need to hear this, I want you to share with them. Also, I want you to comment. Have you ever experienced in your life or someone that you know that somebody passed away and didn't have life insurance and what they had to go through? I want to hear from you. Have you ever been in a situation where a person passed away and they didn't have any life insurance? How was it handled? Or have you ever been in a situation where you're the one caring for somebody who falls sick or somebody who got injured dramatically? Are you a caretaker for someone right now due to sickness or due to illness? A lot of people are going to be forced into a situation where they are the one taking care of a loved one. And most people don't know how taxing that is. Most people do not know how taxing that is until they get into that situation. Right? 58. You're gonna get a lot of information today, a lot of data today. Again, like I said, you're gonna learn more today than most Americans know. 58% of adults believe Medicare will cover long-term care costs, but it just simply won't. Medicare only covers very limited skilled care and short-term assistance. That's it. And mainly medical bills. That's it. People are often terribly mistaken about this, and they find out too late. A lot of people throw a Band-Aid at a bullet wound. That's literally what people are going through right now, right? They're thinking they have Medicare, but they actually need long-term care. And they're believing that Medicare will solve their problem. And it doesn't. Question for you, if you're in the chat right now, if you thought Medicare covered long-term care, I want you to type, wait, what? If you are on the chat right now, right, on this live right now, and if you ever thought that Medicare covered long-term care, I want you to type, wait, what? Because a lot of people believe that. I've been in the financial service arena now for about 18 years. And if you hear the type of things that I hear from people, and I'm like, where are you getting this information from? I've heard from people, oh, I'm going to get a certain amount of money from Social Security for retirement, so I don't need to save any money. I've heard that I don't know how many times. I've literally had a lady tell me, oh, I'm going to get $6,000 from Social Security. I'm like, really? Really? Okay. I've heard people tell me, oh, Medicare will take care of me if I was to get any kind of illnesses and things like that. I was like, really? Really? You sure about that? So a lot of people actually believe this. You guys may want to take your pen and paper out, right? Because what I'm about to tell you right now is going to shock you. Okay? As of 2025, this year, okay, the average cost for an assisted living facility can be around $70,000 a year. If you live in Maryland, the DMV is running anywhere between $100,000 to $112,000 for an assisted living facility. If you don't want to go into an assisted living facility and you want someone to come to your home and care for you, it's running you roughly $77,000 a year. If you guys know any nurses, ask them. Some of the people who they care for, ask them how much does it cost those people a month to take care of them. A nursing home can be upwards of $127,000 a year. A year. So the title of this live today is "A lot of people are unprepared." A lot of people don't have life insurance. A lot of people don't have long-term care coverage. And the numbers I just gave you are actually real numbers. These are data. If you look up in your state, it will tell you how much it costs for a nursing home in your state. It will tell you how much it costs for a home health aide to come and take care of you if you are sick or injured. You guys can actually look this up. I'm going to give you an example. Let me give you an example. If you need care for 3 years, that could exceed $300,000. That's enough to wipe out most people's retirement. And this is what I mean when I say when a lot of people plan for retirement, for some reason they exclude the health side. The longer a person lives in retirement, the likelihood that they will need some form of long-term care. And most people usually get financially bankrupt because of long-term care costs. Hey, listen, if you're watching this live today, let me know what state you are in. What state are you in? If you're watching this live today, and have you looked to find out how much it will cost you in your state if you needed to go to a nursing home, or if you were to get injured or sick and you needed a nurse to come and take care of you and provide for you, help you take a shower, help you brush your teeth, help you comb your hair, help you lotion up, help you eat your food, help you change your clothes, even wipe you when you have to use the bathroom. A lot of people don't even want family members doing that for them. But at the same time, they don't have money put away for somebody to come in and help them. If that number that I just told you today shocked you, I want you to type in the chat, wow. I want you to type, wow. The average retirement savings right now is $187,000. That's the average retirement savings. And you factor in the fact that an individual falls sick, you will wipe out your retirement savings. What state are you watching from today? I know some of the state with the most expensive assisted living and nursing home is Maryland. Maryland is on that list. Maryland is on that list. Connecticut is on that list. Is this something that you actually ever thought about? Most people have not thought about this. So when I sit down with my client, it's not just about money to pay bills and eat and whatever. It's another side that people don't factor, which is their health. Let me tell you why not planning can be devastating. And more people plan for parties than they do fully planning for their retirement or long term. More people plan grocery lists than they do planning for their retirement and long term health. There are real consequences for not planning. If you were to fall into a long-term care situation, your family will most likely have to sell assets to pay bills. They most likely will have to use credit cards and go into debt. They will have to cut everyday expenses just to survive. And in most cases, they will have to delay retirement because they've maxed out everything they have: savings, IRAs. Some people I've even heard have took money equity off from their home, right? Some people have taken equity out from their home to be able to pay for care for their loved ones, financially ruin them. And it's funny, in most cases, long-term care happens to you when you need the money the most, usually in retirement. In most cases, not all, it happens to you not when you're younger, but when you're older and you don't have time to recover or recoup. right? According to long-term care surveys, families report cutting back spending, losing savings, facing utility payment trouble, which means they can't pay for their utility bills, and even delaying retirement because of care costs. So sometimes when we see people who are working at Walmart or McDonald's, or or people who are a little bit older of age, and we're sitting here wondering why they're there. We don't know their story. In most cases, it's probably 80% of the time it's going to be bad planning. Let me tell you this. I've been around now for 18 years, and I've heard stories from families, devastating stories. When long-term care costs hit, they hit hard. It's one of those Mike Tyson uppercut blows. Let me ask you a question. If you're caring for a loved one right now, I want you to type real talk. If you are caring for a loved one right now, I want you to type real talk in the chat. If a loved one needs care for 3 years, it's going to run you about $300,000 for either an assisted living facility or for somebody to come and take care of you. Miss Nicola, yes, real talk. I have an agent right now who her mother is going through that with her father. And I remember I spoke with them maybe 10 years ago in reference to getting this policy. The father didn't want to hear the conversation. The mom at least listened, but they didn't move forward. Fast forward 10 years later, the husband got cancer real bad, and now her work time is limited because she either goes to work, and by the time she gets there 2 or 3 hours in, they're calling her because something happened to the husband, so she has to run back home, or she has to call off of work. She's not getting any sleep because it's constant care 24/7. These are things that happen to everyday Americans. And we just simply do not put it as part of our plan because we believe it will never happen to us. Right? A lot of people, I said it in my live a couple of weeks ago. A lot of people get bad advice from people. A lot of people are getting their advice from their co-workers, their neighbors, their friends, their family. And in most cases, these people don't even have a plan themselves. It's literally an echo chamber. They're just repeating whatever somebody else said. Most people are not sitting down with advisors to get the proper information. Let me give you one of the myths that people that's circulating out there. Medicare will pay. Medicare will pay. That's one of the myths. Millions believe that Medicare will cover long-term care, and the fact is it doesn't. The other myth that's out there is term life insurance plus 401k equals protection. That's also a myth because term life expires and your 401k can lose money in a bad market. And hope is not a strategy. If you're watching this right now and you have term life, I want you to type in the chat term. Because a lot of people don't know how the term life insurance work. So I'm going to educate you guys today. Again, today you're going to learn more. Oh, you're welcome, Miss Nicola. Yes. I'm glad I was able to get you together and get you going. Yes. Thank you for that. You're going to learn more today than most Americans know. A lot of people have term life insurance and they believe they're good forever. So what I'm going to do is educate you today. If you buy a term life insurance, whether it's 10-year term, 20-year term, or 30-year term, it has an expiration date. That's what those numbers mean. I buy it for 10 years. After 10 years, I can keep it, but the price goes up dramatically. So I'm going to give you an example. As a matter of fact, it's a gentleman who I'm dealing with right now with a situation like that, who bought a 10-year term 10 years ago. The insurance company sent him a letter in the mail. Your term is about to renew, and he didn't know what that was. And when he called the insurance company, initially he was paying $80 for his policy. Now his renewal is going to be $170. And then the following year it goes up to $210. Then the following year after that, $300 something. So you guys can imagine how upset this guy was, because for some reason he thought his policy was gonna, and I don't know why he would think this, because it's a 10-year policy. So term policy does not last forever. If you are 40 years old and you purchase a 30-year term policy, that puts you at 70. The price for that same policy at 70 is going to be astronomical, which is why most people end up canceling it. Now, here's the problem. You've held on to that policy for 30 years. You bought it when you was young, fit, vibrant, healthy. 30 years gone by, you put on 60, 70, 80 pounds, right? You may have developed certain things like diabetes, maybe had a heart attack or a stroke, something, right? Now you're left with the decision of, well, I bought this at 40, $500,000 policy. I was paying $100 a month. Now I'm 70. Now I'm going to have to pay $400 a month. Most 70-year-olds are not going to be able to pay that. So they end up canceling. Well, now you cancel. Now you have to reapply and get a new rating based on your age and your new health. This is the reason why you see most people with 50K life insurance policies, 25K life insurance policies, because at 70, they cannot afford $500,000 policy. This is one of the reasons why I almost lean towards permanent policy, because your premium is fixed for life. You don't have to worry about going through changes after your term run out. Also, let me let you guys know something about permanent policy. If you pay that policy for 30 years straight, there's a high likelihood after that 30th year, you will not have to make any more premium payments you can now call the insurance company and say, hey, can you now start to send me income from this policy? So you're getting your Social Security, you're getting your 401k. At the same time, the insurance company is sending you a check from this policy that you invested in for the past 30 years. This is the reason why a permanent policy makes so much sense. With the 401k, there's two risk factors that's going on there. One, the market downturn. If some of you guys are on this live right now and you're around my age, so I'm 48 years old, so you remember the dot-com bubble, you remember the mortgage crisis bubble in 2008, okay? And some are saying we're actually in a crisis right now, okay? So that's 3 recessions for an individual around my age. If your money was in a 401k or is in a 401k, you've probably been hit. Is it okay to have a permanent policy and the policy you started me on? Is it okay to have a permanent policy and the policy you started me on? I'm a little confused about that question, Nicole. Can you retype that again? So with the 401k, if the market, take a downturn, you lose money. But let's just paint a perfect picture. Let's say the market, you were never hit by anything negative in the market. Now you get to retirement age, right? 59 and a half, 62, 65, whatever age you want to retire at that point, right? Now your silent partner comes knocking on the door and say, hey, I need my share, which is the I to the R to the S. The IRS now won anywhere between 35 to 43% of your retirement income. That's what the 401k offers you. The life insurance makes so much more sense. The cash value life insurance, what I mean, not term, because it protects you from the downturn of the market. That's one. And it also protects you from the IRS. That's 2. Right? A lot of people are information gatherers. People get on these live. You helped me with a policy a few months ago. Should I also have a permanent policy? Hey, Nicole, okay, so we need to sit down and have a conversation again, because what you do have is a permanent policy. What you have is an indexed universal life policy. So exactly what I'm talking about right now is exactly what you have. No problem. That's actually a good question, because because people they're just learning about this. So it is a lot within it. So most people, because we do annual reviews every single year with our clients. So over time, the client start to get it, they start to understand it. So you're fairly new into your plan. So that's actually a great question. A lot of people want to wait before they take action. And I say this, for example, in reference to life insurance, waiting will cost you money. And also your health will also decline. That's number one. When it comes to investing, a lot of people want to wait. Oh, I'll wait till later. Well, here's what a lot of people don't know. To make money, to build wealth, you need really two things, really three, but two are the main one. One is time and money. The third one is interest, right? But the big ones are time and money. You can never get time back. So a lot of people waste time and then they get, I'm dealing with a lot of them right now. People who are in their 50s, almost 60, now trying to, I just got on the phone with one today. Now trying to get started for retirement. Let me share some information with you guys. You got two people. They're both trying to get to an end goal, which is, I'm gonna throw a number out, $1 million. Right? One person started at the age of 25 years old. That person only has to put away $250 a month, all the way to age 60, to get $1 million. But then you have another person who want to wait to their age 50 and now want to start running around to put money away to retire, and they also want $1 million. That person at age 50 is probably going to have to put away $3,800 a month just to get to the same goal. This is how important time is. One person started early, they're putting away 250, 280. Another person started later and they're putting away 10 times and more just to get to the same goal. Right? So I always tell people it's always better to start with something than nothing. Because even if you start small, because of the length of time you've been in it and the compounding of interest is going to accumulate for you, than to start with nothing and then want to figure it out when you're this close to home, when you're this close to retirement. You want to figure it out. So you're 60 years old and you want to retire at 65, 5 years, but you have zero saving. Most of my live, I bring this article up. Is by AARP, right? And AARP put this article out last year, November of last year. It says 30 to 40% of people between the age of 50 and 66 have zero retirement savings. Let me repeat that for you guys one more time. Okay? 30 to 40% of people between the age of 50 to 66 have $0 for retirement. No IRA, no 401k, no IUL, no savings in the bank account, $0. And then in that group, 60% plus say that they know they don't have enough saved for retirement. We're going to get real tonight. We're going to get real tonight. Now that we see, because I like to simplify stuff, I don't like confusion. So now that we see the problem, let's talk about some solutions. And hopefully as you're watching this today or you watch it later, you start to say to yourself, you know what? Enough is enough. And I got to take some action. I got to figure, you know, the main reason why people do not take action is a lot of people don't want to let go of their lifestyle. In my 18 years of doing this, I realized that because most Americans make good money. Most Americans make good money. But a lot of Americans want to live like the Joneses. It's just that simple. Most people don't want to let go of their lifestyle. Let's go over some solutions. And again, if this is your first time watching me, what's the best type of life insurance? This might sound biased, but I prefer. I'm not saying it's the best, but I prefer the index universal life policy. Every family is different. Every scenario is different. I will always say this: you have to have money to be able to fund a IUL. And if a client don't have that kind of money, I usually get them started with a term policy. And then over time, as I'm educating them, as I'm going over a budget with them, then we can transition into a cash value policy or a IUL. And the reason that I personally like the IUL is one is permanent. One is permanent. It will outlive me, which means because the whole plan to me of life insurance is generational wealth. Most people are not going to be able to build generational wealth on their own. Most people don't have businesses. Most people don't have inheritance that came to them that they're transferring over, and most people, again, as we know in America right now, their average retirement savings is $187,000. So most people are not going to be able to transfer wealth to their family. So the easiest way to do it and the lowest cost way to do it will be life insurance. Okay, how much is a good amount to start? Again, everybody, I have a okay. It depends on the individual and what your goals are and how much coverage you're trying to buy. So, hey, let me give you my number. You can text me, right? Or you can message me. After this live is over. Follow me. I do a lot of education on this, but let me also give you my number. You can text me and I'll get back to you. That's 443-208-5480. That's 443-208-5480. So I am 30 years old, man. You are at a perfect age. 30 years old. If you get started right now and you're consistent with it, life is going to be grand for you. I always tell people the earlier you get started with your long-term plan, the better the future is for you. So you're at 30, you're looking good. If you get started right away, you're looking good. So that number again is 443-208-5480. Text me. I work better with text. I have a $100 budget. Is that enough? Yeah, text me. We'll go over it. I mean, again, it's a starting point. I'm a person who loves to work with budget and then grow into that savings. You understand? Like if you don't have $500 or $1,000 to save, that don't mean you don't get started at all. You get started with something, and then you kind of like grow from there little by little. And this is just me being personal with you guys. My first policy was $280 a month. That was 17 years ago. Now, obviously, I've grown into management and bonuses and things like that. So on the average, I kind of I put out about $1,500 a month in my IUL. Now, the reason why I fund mine that way is I want to retire no later than 57. I don't want to work past 57. So I threw a lot of heavy, you know, premiums into my plan so that way I can stop working at no later than 57. I want to start working early so I can enjoy life. You understand? So that's my personal goal. Why do people say they're bad? I've seen lives on TikTok. A lot of people don't understand it. That's all. And then when a lot of people, compare the price compared to a term, they feel as though, oh, because again, they don't understand it. They don't understand. So I'm so glad you bring this up. The easiest way to explain this to people is this. Term is cheap because it's like renting an apartment. I don't own it. It's temporary. So it's going to be cheaper, like most apartments are. Most apartments, in some cases, are cheaper than you buying a house. So, but when you buy a house, guess what? You own it. You're building equity over time that you can withdraw from. So in most cases, this is why a lot of people don't understand. Oh, IUL is so much more expensive than term. Yeah, because with the term, you're literally just giving your money away to the insurance company because it will never pay out. And even once you're done with it, you don't get nothing from it. With the IUL, it's like you own it a home. You have a mortgage, you're paying into it. Over time, it's growing in value. You're building equity that you can pull money from to do whatever you want to do with it. So a lot of people don't understand it, and they don't understand how it works. That's why some people say what they say. It's just lack of education. And most people that I hear that say that are usually people who are, especially agents who say that, they probably only been around for less than a year. So they don't understand it, and they're only going off a base of cost. That's like, for example, someone's trying to say, oh, the Mercedes costs more than a Honda. Of course it does. It's so much more value in the Mercedes than a Honda. Is a Honda good? Yes, it is. But is a Mercedes a whole lot better? Yes, it is. Safety factor, all the gadgets, that's in there, the value that it holds after, you've had it for years. Yes. That's the, you know what? Let me say it this way. Term, and I hope I don't offend anybody. Please don't nobody on here get mad at me if I name a vehicle that they're driving. Okay? Term, Kia. IUL, Maybach. Okay? Okay? That's the easiest way that I can explain it because I own a Maybach. So I understand the difference. Okay? Term, Kia. IUL, Maybach. It's just that simple. And again, I hope I'm not offending anybody. There's nothing wrong with a Kia. I'm just trying to simplify it for people out there to understand, the value of what they're getting. It's two different products. Right? So yes, text me, and you and I can connect. And again, whatever your starting point, again, you're young. So even you starting, I just bought a Kia. I knew that was going to happen. I knew someone. Hey, listen, again, I'm not trying to, I hope I didn't offend you. I say, oh, Kia's good. It's a wonderful car. But again, I'm just trying to, help you understand kind of like, the best way to understand what the two product, what the value of the two product brings, to the market. That's it. All right. So Let's take a minute to go over the solutions here. Number one is you need insurance with living benefits. That's number one. So certain life insurance, have, for example, with a term policy, is just you die, they pay. That's it. No other value other than that. Then you have the IUL that has three things that's tied to it. Number one is you die, they pay. Number two is living benefits. You fall sick, they pay you. So let me break that down. So for example, most IUL have terminal illness, chronic illness, and critical illness. In a situation with, let's say, a critical illness where a person get cancer, heart attack, stroke, dementia. Some of you guys may not know this. If a person have a heart attack, it usually takes them about 9 months to almost a year to fully recover. Between surgery, physical therapy, healing, it takes about 9 months to a year to fully recover. Well, we know most Americans have less than $500 of savings in emergency funds. So if that situation was to happen, you can now trigger your life insurance and get income from it. That's why it's called living benefit. I'm gonna give you an example. One of my good friends that I've known for over 30 plus years, she got diagnosed with cancer 2 years ago. We filed a claim. Her policy is roughly about $300K. Okay, her income is about $78,000. She only took out 1 year's salary because her thought process was, hey, I just need enough to not have to work for 1 year while I focus on my health, but the bills can still get paid. The mortgage can get paid, the condos can get paid, the kids can be taken care of, groceries, all that good stuff like that. So that's living benefits, which means that if you fall sick, the insurance company pay you. Okay. Then there's the cash value side, which a lot of people use in a way for retirement, but you can use that for whatever. And again, this is me just being transparent. I don't know if this is a good thing to tell you guys on live, but when I bought my Maybach for my birthday last year, I took out 20 grand for a down payment. I had $5,000 in my liquid account savings, and I took out 20 grand for a total of 25,000, 20 grand for my cash value policy, my IUL, and I added 5 grand for my savings account. So I put down $25,000 on that vehicle. Now, that's bad advice, so I don't want you guys to do that. But again, it was just the perfect model. As a matter of fact, the dealer called me and said, hey, that car's here. Come check it out. And, it was the perfect one. You know what I'm saying? So at that moment, all I had liquid was 5 grand, but I had some money in my policy that I was able to take out to buy the vehicle. So again, it's not a good advice, you know what I'm saying, to tell people. But as soon as I did that, I increased how much I'm putting into my policy. So I kind of put a little bit extra. That way I can make up what I took out quickly. Okay. So you have to pay back. No, you don't have to pay that loan back. No, you don't. No, you just continue making your monthly premium. Okay. And listen, people get that confused. And I'm so glad you're on here. I love this interaction. Thank you so much for this. Let me tell you the way it works. The reason why the cash value, the policy, when you get the money, is tax-free is because in America, loans, you don't pay taxes on loan. So what the insurance company does is this. Let's say inside your policy, you have $100,000 cash inside your policy. If you pull it out, it can become taxable. But if they give it to you as a loan, then you don't pay taxes on it. So what they do is this: they will now. So you call the insurance company, hey, I need $20,000 for whatever. Okay, now what they do is they take 20 grand of your money, put it into their account, and use it as collateral to pay you the $20,000 that you want. Okay, that's all it is. So what they've done is they've already taken the money out from your account. So they've gotten their money and they write a check for you in a loan format, so that way you don't pay taxes on it. It's just a strategy that they use. That's it. So I know a lot of people go out there, oh, you gotta pay that money, pay the loan back, like your 401k, for example. If you take out money from your 401k, you gotta continue to make your contribution, and then you also gotta pay extra towards the loan. With the life insurance policy, you just continue to make your monthly premium as due. The only reason why I was putting extra towards it is because I wanted to replace the money that I took out sooner than later. Because ultimately, the reason why I got that plan, so that way I can retire early, right? That's the reason why I put a little bit extra towards it. But you don't have to do that. Just know whatever you're taking out is what's going to be minus from your money. That's it. So that's another bad information that people get when it comes to the cash value policy or the IUL and things like that. It's not. It is a loan, but it's structured that way so the IRS don't tax you. That's all it is. Because in America, you don't pay taxes on loan. No, they don't subtract from the death benefit. There's two sides to your policy. Well, three in the IUL, but there's the death benefit and there's the cash value side. So, example, give me a second, guys. Example, right? Your policy is $500,000. That's your policy itself. That's the life insurance itself. Okay. Inside your cash value, you have $100,000. So now, and again, depends on how your policy is structured. If it's level or increasing. I'm gonna educate you guys today. I should charge for this, but that's okay. Listen, if your policy is 500 grand, and let's say it's structured as increasing, and your death benefit is $100,000, now your total policy value is $600,000 because you have $100,000 in there cash, and then you have a $500,000 death benefit. That's 600 grand. If I took out $20,000, now I'm left with total value $580,000. But the money is not coming from the life insurance; it's coming from the cash value. The only time the life insurance get hit is if you are taking money out for living benefits. If you fall sick, cancer, heart attack, stroke, dementia, if you trigger the living benefit side of your policy, then yes, that money is coming from the life insurance itself. I hope that answers your question. Okay. So again, most policies don't have living benefits, but the IUL do have that, and again, that covers you in the event of some kind of like an illness or whatever. Okay. Number two is instead of temporary coverage, which we talked about earlier, right? Permanent strategies can give lifetime protection and can help build cash value and provide options for you as you get older. Does term have living benefits? Yes, some term do. Some company, if your term policy is older than 10 years, in most cases, it might not have living benefits. So this is something like new. You understand? So, but not all company term policy have living benefits. So yeah. And the next solution is solution number 3 is, which I talked about a few minutes ago, is start early. The earlier you start, whether it's you getting insurance or whether it's you starting to save for your retirement or whether you're concerned about long-term care, the earlier you start, the better it is for you financially. The earlier you start, it saves you money. And the earlier you start, the more wealth you will accumulate. Right? Insurance should protect your life, not just your death. And this is one of the reasons why I love the IUL, because it actually protects every aspect of your life. One product covers every aspect of your life. If you were to pass away, your family is taken care of. If you were to fall sick, you're taken care of. If none of those things happen, and God bless you with a long life, you can now start to get income from the policy to live off of, i.e. retirement. So if we look at, for example, a IRA, it only covers one thing, retirement. If we look at a 401k, it only covers one thing, retirement. If we look at any stocks, bonds, mutual funds, it covers one thing, income. If we look at term, it covers one thing, death. The cash value policy covers the 3 most important things that can happen in your life. Somebody pass away, somebody fall sick, and lastly, money during your old age that you can survive off of, and you don't need to become a liability on your family. So as I'm about to close out with this, I want to thank you guys for being on with me. Right? Term insurance is temporary. It's not a lifetime solution. 401k should never be your only retirement safety net. It's just too risky. Talk to people who experienced 2008, 2009. As a matter of fact, the people who went through the 2008 mortgage crisis, most of them are either just now recovering since 2008. Since 2008. Medicare isn't a long-term care plan. It's a short-term medical plan. Right? Most people are not broke because they earn too little. They're broke because they never protect what they have. Again, I mentioned before, a lot of Americans, we live in America. Most people in America make extremely good money. But the problem is most people don't want to let go of that lifestyle. The brunches, the happy hours, the traveling to exotic places, the luxury ticket items, the Gucci's, the Louis, all these things. Now here's the thing: I'm all about a good time. I love to travel, all that thing. But again, being transparent with you guys, right? I put away about 38% of what I make every single month. between my IUL and my deferred comp plan, about 38% of what I make goes into those plans. So if I choose to go out and do things, and for myself, I think I'm okay with that. But most people don't even put away 10% of what they make. And they put more money towards things that don't matter. As you're watching this today, tonight wasn't about fear. It wasn't to scare anybody, but it's to bring awareness. It's to bring awareness. And I believe once you're aware, that leads to you preparing. And I'm gonna give an example. So earlier this year, I did a live on about the article that AARP put out last year. And again, that article states that 30 to 40% of people between the age of 50 to 66 have zero retirement savings. And I had one gentleman call me and say, "Hey, I watched your whole video. That was about me." Mr. No Cash Value, thanks for hopping on. I appreciate it. Yeah, I think I'm gonna do the bow tie all this week. Thank you. So he gave me a call and he was like, "Hey, that video I saw is about me. I'm 53 years old. I have no retirement savings. When can we meet?" And he immediately came to my office that same week, drove all the way from Virginia, an hour drive, to come to my office. And we got his plan started the same day. Because he said, "Listen, I've been procrastinating. I've been saying I will. I'm doing the numbers, and the longer I wait, I know I'm hurting myself." So tonight's live is not about fear. It's trying to make you aware, trying to make you take a step back and say, "Hey, where am I at right now? What are my goals? When do I plan on retirement? What do I have right now for retirement?" Awareness will always lead to preparation in most cases for some people, and preparation will always lead to peace. If you start to prepare, you start to feel a peace about you, a calm about you. If you're scattered, fear is involved. But when you have a plan in place and you put that plan into motion, you start to feel a calm about you. Listen, as I'm wrapping this up, if you're serious about a plan that protects your life, your income, your health costs, and your legacy, again, you can DM me or you can text me at 443-208-5480. That's 443-208-5480. Let's make sure you're prepared for life, period. Okay? Not just hoping for it, but make sure you are prepared. And I'm going to close out and reiterate with you guys some of these data that's out there. And you guys can actually look this up for yourself. 70% of adults turning 65 will need some form of long-term care. 70%. You have to realize the food that we're eating in America. There's sugar in everything. There's dye in everything. Most Americans do not work out, right? So with that being said, there's probably going to be a need for some of these health situations. It is what it is, right? But only 10% of Americans have long-term care coverage. So I want you to see how crazy that is. 70%, based on the data, 70% of adults turning 65 will need some form of long-term care. And trust me, I've helped clients file living benefits claim. I did one a few months ago. A client in Georgia. The daughter called me, "Hey Max, my dad is not well. My mom is taking care of everything. It's kind of hard on everybody right now. His policy, what does it cover?" And we called his doctor first and found out what's wrong with him. Okay, they give us the paperwork, send it over to the insurance company, and they cut him a check. The mother was the one caring for this guy because there's certain things that he couldn't perform on his own. And he's been a client for about 8 years or so out in Georgia. 58% of people wrongly believe that Medicare covers long-term care. And that's a lie. 60% of Americans have life insurance, and 33% feel underinsured. And families face real financial hardship when they are paying for care. Again, you guys, if it may have not affected you personally, but I'm sure you know somebody who have had to take care of a loved one because they had cancer, they had a stroke, they're going through dementia. You guys should have conversations with those people. See, a lot of people are private. A lot of people don't talk about what's going on in their household. This is why some of you guys don't know how hard this is. Some of you guys should have conversations with these people. Or even better yet, some of y'all should go to some of these assisted living facilities and start asking questions. Some of y'all should go to some of these assisted living facilities and start asking questions. It will scare you. Listen, I want to thank you guys for getting on my live. I appreciate you guys who was on me for a minute. And again, if y'all need me, hey, text me at 443-208-5480. That's 443-208-5480. Or DM me. Listen, you guys have a wonderful and blessed rest of your day. I'll talk to you in the next live. Have a good one.